We promised you that we'll get you Credit Suisse's Neelkanth Mishra's view. He's raised a red flag over slowdown. He says it may worsen going ahead as well. He believes narrow performance could continue till the mid of 2020. And here's an excerpt of that exclusive interaction that we've had with him.
It's actually not just foreign flows. So our conclusion is that the broader market remains supported. We saw the market hitting new highs today, and I think that kind of change should continue. There are several reasons for that. We expect that domestic flows, which in the last 12 months have been nearly $20 billion, should continue. I mean, they may weaken slightly from here, but that will be enough to support the market. Globally, there is a risk-on happening. So it is not as much rapid acceleration of growth at this stage than reduction of some big uncertainties, overhangs, and that should mean more flows to the market. Globally, markets are not cheap, and therefore India's PE does not really look compared to its own history. Of course, it is a bit expensive, but compared to where equities are globally, I don't think the market is very expensive. Even on the EPS side, while the current estimates of 28% for FY20 and then, FY21 may not really transpire, I think it'll settle at 12-14%. But that kind of a rollover impact, because then by the end of the next financial year or next calendar year, we'll be talking about FY22. And some of those again, so we will be at least 12-14%, at least the forward EPS will be higher. So I don't expect the market in aggregate to do very badly, but we are staying cautious within the portfolio in the sense that we continue to prefer large liquid banks. There's this new phrase that has gained traction in the last 2-3 months of a quality bubble. I don't see if it is a bubble deflating anytime soon. We are starting to move some of our allocations away from really expensive stocks. Stock trading at 70-80 times earnings at no point can be considered very attractive. But there are growth stocks which are slightly cheaper, but again low risk, which we have moved to. So we have moved a bit to PSU banks. We have also, in response to the global cyclicals, kept an overweight on metals. One of the recent changes we made was a downgrade of industrial. So we had been very positive last year, our last year's outlook, because there was a turn in industrials and investment capex that we were seeing. But right now we think that because of the economic slowdown that has been kind of pushed out by a few quarters, if not a year.
So let's break those points into one by one. You spoke about how global liquidity has turned favorable once again, lifting all risky assets, and India is also a beneficiary of that. How meaningful do you think it could be? Last time round, it actually triggered a very big wave of risk on. Do you think this time round, how do you compare the two occasions?
See, the first decision when this happens is that money has to be put into India, right? Or let's say the first decision is we have to buy equities, then okay, we have to buy emerging market equities, and then 7-8% has to be put in India, right? And then the India fund manager or the EM fund manager has to decide what to buy. So coming into India is unrelated to what you buy in India, right? And so once you come into the market, then you ask whether a private bank trading at 4 times book is okay, or should I buy a private bank trading at 2 times book? What are the risks of surprises, negative surprises in the next 1 year? And then how much of a risk should I be taking? So it is not necessarily a mandate, or the fact that there is a global risk on does not necessarily mean that within the market as well that you will start buying small and mid caps, the slightly less liquid names, things which have a greater exposure to the domestic cyclicality.
Sure. Talk to us about how your interaction with your clients are happening right now. After you release the note, I'm sure you must have been interacting with your foreign clients. To get a flavor, is this active money which is also looking at India now in the last 2 months, or is it only ETF-led money which India is attracting?
No. So,
and where exactly are the inquiries?
See, the share of ETFs in the flows is not more than 12-13%. I mean, it was 11-12% till a year back. So I don't think it is it is as passive as that. But just because it is not ETF doesn't mean that it is like active in the sense that people are deliberately choosing to be in India. I think it is more of that. Okay, so there is an emerging market fund. Say suppose it gets $100 million. Then if India's benchmark weight is 8%, then you can choose to put 7% or you can choose to put 9%. So that is where the difference is. So it's not that they're saying, oh, now look, India is turning, the economy is turning, and let me go and buy something. There is a view. There's a view that people have that if you have to buy the market, you have to buy it when GDP growth is 4.5%. You shouldn't be buying it when the growth is at 10%, because it's when the prospects look the worst that you will get the best opportunity to buy. There are people who have that opinion as well.
That was an exclusive interaction with Neelkanth Mishra of Credit Suisse.